Good morning, ladies and gentlemen. Welcome to the Czech National Bank's meeting with analysts. Today, we will present our new macroeconomic forecast, which was prepared by economists from the Monetary Department. And after the presentation, we will open the floor to the discussion and your questions. Today's speakers are Deputy Governor of the Czech National Bank, Eva Zamrazilová, Executive Director of the Monetary Department, Petr Král.
Hello to everyone.
And Director of the Macroeconomic Forecasting Division of the Monetary Department, Karel Musil.
Good morning.
Let's begin with the macroeconomic forecast, which will be presented by Petr Král. You have the floor.
Thank you for the floor. Good morning, ladies and gentlemen, dear colleagues. Once again from my side, it is really my great pleasure to be here again to deliver a presentation on the new quarterly macroeconomic forecast of the Czech National Bank. Let me start by highlighting the structure of my presentation. Sorry. First of all, I would like to stress the assumptions based on which the new forecast was prepared. Then I will take you through the new macroeconomic forecast, through the qualitative story and the quantitative dimension of the new outlook we prepared. Later on, I will briefly compare the new forecast with the previous one. And final part of my presentation will be dedicated to the further scenario we prepared to address and describe a major risk we felt when we were preparing the baseline scenario and when we were discussing the risk and uncertainties of this scenario with the board members. Let me start to have a look on the external side assumptions of the new forecast. The countries of our major trading partners, which is the euro area in the effective terms, are undergoing an economic downturn, and broadly for this year we can expect almost a stagnation in the GDP growth or GDP economic activity, which is a result of slowdown in global demand and international trade, which is supported by restrictive monetary conditions around the globe delivered by major central banks in the US, in the euro area, and by the Bank of England. We can expect that euro area economies will recover when it comes to their economic activity in 2024. We have been observing quite sharp decline in the PPI inflation rate over the last couple of quarters, which is driven primarily by the energy component. But as you can see in the respective chart, also the core segment within this PPI growth has decelerated quite significantly. The outlook for a 3M Euribor is taking into account the delivered tightening by the ECB and the ongoing program of reduction of its balance sheet. The crude oil price market outlook is slightly declining from the current quite elevated levels. Let me now turn your attention to domestic assumptions. Let's start with the fiscal policy side. We can expect that following this year quite significant nominal government consumption growth, we can expect only mild increase in government nominal spending for 2024, which will be caused by the effort of government to curb wage and salaries growth in public sector, together with some cuts in operating expenditure under the consolidation package, which is currently being in the final phase of its approval in the parliament. Fiscal policy, on the top of that, will make roughly quite negative contribution to GDP dynamics in 2024. We estimate the negative fiscal impulse to be minus 1.1% in terms of its contribution to the GDP dynamics, following this year's roughly neutral fiscal policy stance as measured by this particular indicator. For 2025, after the consolidation package, direct effect will fade away. We can expect the gradual return of fiscal policy to roughly neutral policy stance. We can expect, looking at the administered price inflation segment within the consumer basket, that we can expect in the near term a rapid acceleration in year-on-year dynamics driven by especially electricity prices for households. This is a pure technical factor caused by last year's low base, driven by the introduction of the government energy savings tariff, which lowered for 3 last months of the previous year the comparing base for this year's year-on-year inflation computation. This will accelerate not only the regulated price growth, but the CPI growth as whole, and I will get to it in more detail later on. After this effect fades away, we can expect sharp decline in administered price inflation to single-digit levels, but their dynamics will stay somewhat elevated compared to figures we saw many years ago. This will be a consequence of the sharp increase in the administered component of energy prices that are linked with the abolition of government energy distribution subsidies and by the reintroduction of the fee on the renewable energy sources. This administered price component within the energy price inflation will be outweighing the expected decline of commodity part of these prices that are following the developments on the commodity exchange markets in the world. So you can see that for the rest of 2024, the contribution of electricity prices to overall administered price inflation is significantly positive, leading to a quite non-negligible growth of the whole segment of this segment within the consumer basket. On the other hand, natural gas for houses, prices of natural gas for households are expected to decline as the administered component within the gas is less important compared to the electricity prices. In this regard, we are very close to the announced figures by the respective authorities from the beginning of this week. When we were preparing the baseline scenario of the new forecast, we were quite lucky to estimate these expected changes with a very significant portion of accuracy. Let me now turn your attention to the story of the new macroeconomic forecast. The disinflation process in the Czech Republic has been continuing very successfully. As you definitely know, we've got with year-on-year inflation from 18.5% at the beginning of this year to 6.9% in September this year. This inflation process has its fundamental causes, and the inflation momentum is confirming that this disinflation process should continue. But when looking at inflation in year-on-year term, one must be prepared for the short-lived break in this disinflation process, as the low comparing base of the previous year will cause a reacceleration of CPI growth in October. From 6.9% in September, we can expect that for October, the CPI growth should accelerate to 8.3% by the low comparative base caused by the last year's energy savings tariff, as I was already describing. The inflation will be above 7% till the end of this year. After this effect subsides, we can expect sharp decline in the overall CPI year-on-year inflation to the upper boundary of our tolerance band, around our 2% inflation target, in other words, to 3%, and a gradual further decline in inflation to within the upper boundary, within the upper part of the tolerance band throughout the 2024 and 2025. On the monetary policy horizon, which is currently situated in the last quarter of next year and in the first quarter of 2025, inflation will be hovering relatively close to our 2% target. This fundamental disinflation process, which we have been observing and which is expected to continue further, is driven by the subsiding of foreign cost pressures that were concentrating in both energy and non-energy component, together with very subdued domestic demand and domestic inflation pressures. Also, profit margins of the domestic producers, retailers, and service providers that have gone up recently and promoted inflation to accelerate are now just after the culmination point, and they are expected to go quite sharply downwards to the long-term neutral levels. As you can see from the bottom chart, the primary effects of indirect tax changes that are, by the way, a part of the consolidation package delivered by the government will be close to neutral or only slightly marginal in positive terms. That's why the headline inflation will be slightly above monetary policy relevant inflation over the next 2 years. As you can see from the upper chart, the expected significant drop in the year-on-year CPI inflation as from the first quarter of next year will be driven by most component, especially the administered price component will decrease its contribution, and the ongoing disinflation process that is, let's say, fundamentally connected with domestic economy, which is being represented by core inflation, will also continue, and core inflation will decline further at the beginning of next year, despite the expected repricing of goods and services taking place in January next year. Also, food price growth will virtually stop, and fuel prices that are quite volatile will make a relatively negligible contribution to the CPI dynamics. Within the core inflation segment, we have seen a very sharp decline in the previously very bold contribution of imputed rents. Their current contribution is close to zero and will be at quite compressed levels, in the quarters to come, and their contribution will renew somewhat in the second half of our forecasting horizon. The right-hand chart at the bottom is showing how the headline CPI inflation would look like if we subtract the effects of last year energy savings tariff and the abolition or temporary abolition of the fee on the renewable energy sources. Here you can see the fundamental picture standing behind the inflation outlook I have just shortly introduced. From the cost side perspective, we can expect that nominal marginal cost growth in consumer sector, when expressed in Q-on-Q annualized terms, will temporarily accelerate or reaccelerate at the very beginning of next year, which will be given by the significant contribution of the increase of administered price component or administered component within electricity prices for firms. So, because not only domestic households, but also firms will be influenced by the reintroduction of the fee on renewable energy sources and by the increase in this administered part of the price. But after this one-off inflation factor fades away, the dynamics of nominal marginal cost growth, the dynamics of nominal marginal costs will decelerate again and will stabilize close to the steady state levels consistent with the fulfillment of our 2% inflation target over the medium term. From the cost, from the domestic side, price pressures perspective, we can see that the nominal wage growth, which has been quite vivid until recently, is expected to gradually decline over the forecast horizon, and simultaneously the labor efficiency or the productivity gains will somewhat curb or compensate the expected nominal wage growth in their effects on final pricing in firms, together with price of capital, which will turn in the, let's say, standard slight positive contribution, as you can see in the respective graph. I have already mentioned that we can expect quite sharp decline in the markups or profit margins in both consumer sector and intermediate sector within the Czech economy. This decline will be driven by still subdued domestic demand and especially household real consumption, and by the fact that the further increase in energy costs for firms will not be fully successful in transmitting these cost pressures to the final prices for their customers. The decline in these markups will be supported by still tightened domestic monetary conditions and by the expected restrictionary effect of fiscal policy for the next year, as implied by the consolidation package. Looking at the labor market, we have identified that the tightness of the labor market, which had been quite significant until COVID, has been declining or has been moderating somewhat over the last couple of years, but it is still not negligible. But the economy, which is suffering from non-growth virtually, is expected to deliver further, let's say, moderation of the labor market pressures, which will be demonstrated by the fact that expected employment will stop to grow after some time, and the unemployment rate is expected to slightly increase. Against the background of until recently very high inflation and still tightened domestic labor market, the nominal wage growth in business sector has been quite significant, and we can expect only gradual decline in the nominal wage dynamics over the next couple of years, as nominal wages are one of the most persistent variable within the economy. On the other hand, the wage growth in public sector will be less significant, as the public authorities will try to curb wage and salaries growth of public servants and other employees of the public sector. From the perspective of the real purchasing power of domestic households, we can expect that the ongoing and further disinflation process will cause that wages and salaries in real terms will turn from negative to positive territory when it comes to the growth rate, and this renewal of real wage growth will contribute to expected recovery in real household consumption, which will be simultaneously promoted by the expected gradual decline in the currently very elevated savings rate. And this savings rate is expected to gradually decline from the current levels to the long-term average over the forecast horizon. The Czech economy has stopped growing virtually, and for this year as a whole, we can expect that the GDP figure will be around minus 0.4%, which has been driven by still very, very subdued real household consumption. Household consumption will pick up, as I was just describing the story about the real wage growth, but for this year, the contribution is significantly negative. And this negative contribution of domestic household consumption is not, let's say, capable to compensate the is not able to be compensated by significantly positive contribution of net exports. So the economy is expected to recover only in 2024, when the household consumption recovery is expected to become true, and when the net export contribution will continue. Still, positive growth in gross fixed investment in the economy is promoted by both fixed investment in the firm sector, and as firms are still motivated to invest into the digitalization, robotization, and automation, and for this year also by the effort of the government to spend as much money from the previous EU programming period. For 2024, we can expect the GDP growth at approximately 1.2%, and further acceleration can be expected for 2025. This week's release of the flash GDP estimate by our colleagues from the Statistical Office announcing minus 0.3% in Q-on-Q terms and minus 0.6% in year-on-year terms were almost fully in line with our new forecast. I have just described quite in detail the story about behind the expected recovery in real domestic household consumption. When looking at the gross capital formation as a whole, we must expect further negative contributions of declining changes in inventories, which will be curbing the overall investment activity defined as gross capital formation. But on the other hand, private fixed investment and for this year also public investment will make a positive contribution on the other hand. Czech, very small and very open economy, highly integrated into the global value chains, has benefited from the return of global value chains to normal functioning at the beginning of this year, but the declining demand in our major trading partners, especially in Germany, is now having a negative bearing on export performance. Simultaneously, the still subdued domestic demand has been curbing the import side, and that's why the net export contribution to GDP growth for this year is significantly positive. After the economic slack in the countries of our major trading partners gradually fades away over the next year, we can expect reacceleration in exports, which will drive simultaneously the import dynamics, which will be also supported by expected recovery in domestic demand. The current forecast expects that the exchange rate of the koruna against the euro to be at 24.6 koruna per euros for the fourth quarter of this year. And we have seen some depreciation trend in recent quarters. This trend will continue till the beginning of next year, and will be driven by expected further narrowing of interest rate differential of the koruna vis-à-vis the euro. This interest rate differential will decline, but will stabilize at the end of next year. And this will, let's say, kick off the renewal of the appreciation trend, which will be also benefiting from the upswing of the domestic economy and the renewal of the growth in export performance following the expected recovery in the effective euro area. Consistent with the new macroeconomic forecast is a decline in market interest rates from the fourth quarter of this year onwards. This nominal interest rate decline is driven by the fact that extraordinary foreign price pressures faded away, and also the domestic inflation pressures have been evaporating over time. Looking at the future expected inflation path, we are approaching the point in time under which the current monetary policy stance could become excessively tight, and that's why the forecast foresees the gradual foresees the start of the cutting cycle as from now for the whole for almost the whole forecast horizon. Let me now briefly compare the new forecast with the previous outlook. We have revised our inflation forecast somewhat upwards, due primarily to higher administered price inflation compared to our summer outlook. The GDP, on the other hand, GDP outlook, on the other hand, was revised downwards due primarily to weaker external demand picture. The lower nominal wage growth forecast is consistent with weaker than expected figures we saw over summer and for the second quarter of this year, which is consistent with somewhat less optimistic economic activity for this year, as measured by the GDP data for the second quarter, which are available in the full structure of demand and supply side indicators. The shift in the outlook for the nominal exchange rate to weaker levels is reflecting the observed levels of the exchange rate over the last couple of weeks, and the depreciation tendency is supported simultaneously by the quickly narrowing interest rate differential vis-à-vis euro, and by the outlook for somewhat worse balance of payments for this year and for the years to come. On the other hand, the more marked appreciation next year compared to the summer outlook is consistent with somewhat more pronounced dynamics in nominal net exports over the forecast horizon. Let's have a look at the comparison of the interest rate path and at the individual contributions within our forecasting model. The initial state of the economy is pushing the interest rate trajectory downwards compared to the summer outlook. This initial state contribution is taking into account the lower observed wage growth in the second quarter of this year, together with somewhat more subdued GDP growth for the second quarter of this year. The revision of energy import prices we observed when looking at the data from commodity exchanges over summer and over first month of autumn are making the contribution in the same direction. The contribution of foreign environment is also somewhat negative, which is reflecting lowered outlook for the core component of PPI in the effective area, together with the expectations of somewhat faster expected interest rate cuts by the ECB. The most significant contribution in the other direction, which means the positive to the upward revision of the interest rate path, is delivered by administered price inflation, which is affected for the next couple of quarters by the announced increase in the administered component for electricity prices for households, effective as from the beginning of next year. The expert judgment component is making a positive contribution, as you can easily see from this graph. These expert judgments are, or adjustments are of mainly of the three are making from the three groups of changes. The first one is the explicit influence of the growth of administered component of electricity prices for domestic firms, which will, as I was describing before, affect the cost pressures in this sector at the beginning of next year. This effect is partly offset by the expert judgment, which is lowering the wage growth in this baseline scenario, and simultaneously with the expert judgment curbing somewhat the recovery in household consumption when compared how the recovery would look like if the model would be generating the forecast without any expert judgment and adjustments. We have been preparing, or we prepared the new forecast in the environment of still very heightened risk and uncertainties regarding both domestic and foreign economies. To address and to describe one particular issue or risk we faced when preparing the forecast, we prepared this scenario. The scenario addresses the issue of possibly stronger than expected January pricing of goods and services, which is one major risk which was debated with the board members when we were preparing and presenting them the baseline scenario, and which was also communicated by the governor at his yesterday's press conference. In this scenario, we expect that the January pricing will be more pronounced in terms of its contribution to the headline CPI inflation. The more pronounced repricing in this scenario is heightened by 1 percentage point in its impact, and is done within the core inflation segment. So the repricing in this scenario differs from the baseline scenario when it comes to core inflation, or when it comes to market prices or net inflation. The regulated price growth in this scenario, the food price and regulated price growth in this scenario is the same as in the baseline. Following this assumption, the headline inflation is significantly higher for the whole next year by approximately 1 percentage point. Monetary policy in this scenario responds to stronger repricing with tighter nominal interest rates. In other words, the cutting cycle in this scenario starts only in the second quarter of next year. So in this scenario, the consistent nominal interest rates are stagnant at their current levels until the end of first quarter of next year. Despite this higher nominal interest rates compared to the baseline, the exchange rate of the koruna against the euro is somewhat weaker compared to the baseline because of the, let's say, price competitiveness pressures that are compensated by weaker currency. The higher inflation and weaker koruna will be also affecting the nominal wage dynamics, which is also quite significantly above the baseline scenario. On the monetary policy horizon, this initial inflation surprise disappears, and their effects will gradually evaporate because of the monetary policy reaction, which is tighter than in the baseline scenario, and that's why on the monetary policy horizon, which is now situated in the fourth quarter of next year and in the first quarter of 2025, inflation is back close to the baseline scenario. In other words, back to our 2% inflation target. Having said that, I would like to thank you for your attention by now, and I am passing the floor back to our spokesperson, Petra Vlčková.
Thank you, and thank you for the presentation. This is the new macroeconomic forecast of the Czech National Bank. Now we will open the floor to your questions and discussion. Just let me remind you and ask you, before you speak, please activate your microphone so everyone can hear you, and please briefly introduce yourselves. Is there anyone who wants to ask the first question? Yes, please.
Jaromír Šindel, Citibank. Thank you for the presentation. This morning I watched your interview of Vice-Governor Zamrazilová for the Czech television, and you mentioned there is a strategy that when the central bank starts to cut the policy rate, it should be also followed, discussed by future cuts at the subsequent meetings. If you can describe what is the advantage of this strategy compared to other strategies you discussed. Thank you.
Yes, we were discussing that when we are first prepared to cut rates, we should be sure that we can follow this path in the forthcoming meetings, because I don't think it was a very good idea just to a little trial and to wait what happens next. So we think that, and the second point is that we want to be sure that the inflation is really heading the inflation target, not just for a short time, but for a long time. It will be sustainable. And if you had a look at these two scenarios, it's obvious that the price for waiting a couple of weeks is not that high in the terms of output. So I don't think, if you measure the risks of premature cut of the rates and a little bit behind the curve, cutting rates, I think that the first type of risk is more dangerous.
Thank you. Any other questions? Yes? So, Mr. Vejmělek.
Jan Vejmělek, Komerční banka. Hello to everybody. I have a question regarding new forecasts of key macroeconomic indicators. especially regarding public finance forecast. As I see for 2025, you expect quite a low figure of public finance deficit of 78.8 billion Czech crowns, or 1% of GDP. So what is behind such a, I would say, optimistic scenario? And the second, maybe following question is regarding your money supply forecast measured by M3 aggregate for 2024, even 2025, figure above 8% year-on-year growth. In my view, quite a decent figure, and taking into account your forecast for deficit, my understanding is that the M3 growth will be driven by credit activity towards private sector, so private loans. So how it is consistent with the 2% inflation target? Thank you.
Thank you for the question. Let me start by addressing the fiscal deficit outlook. The new forecast, when it comes to the fiscal side, is fully consistent with the consolidation package measures on both revenue and expenditure side of public budgets, together with the newly available data for the previous public budget developments as it was delivered by the autumn notifications of public deficit and debt. We also are fully consistent with macro forecast as such, with the expected growth in nominal wages and salaries, nominal private consumption, and further indicators. So from this point of view, there is no extra factor that have been taken on board to adjust this forecast. The deficits of public budgets are still quite non-negligible, but they are on a downward trend, and one has to take into account, or one has to bear in mind that part of the consolidation package is going to have a effect as from January 2025. So part of the consolidation effort is to be expected only as from 2025 year. So from this point of view, I cannot give you any more argumentation, but I'm fully in line with our experts preparing this forecast. And the consistency with the M3 outlook is also ensured by the standard procedures. You are right that until now the public sector indebtedness or the growing indebtedness has generated quite significant contribution to the M3 growth. This is related to both deficit and to some portfolio shifts, as for example some institutional investors are changing their portfolios from government bonds to deposits at domestic banks, and this portfolio shift is expected to return somewhat as we assume the decline in nominal interest rates. And the declining nominal interest rates will also promote the recovery of the credit to private sector in both consumer and corporate lending. And this is fully consistent with the 2% inflation target over the medium term. So from this point of view, I would say there is no surprising element in this story.
I just may add that the Bank Board has also discussed the developments of monetary aggregates with and the tie to government spending, and this was we discussed this and labeled it as a risk to the inflation forecast, and it was also one of the reasons of the yesterday decision. And this bank board watch very closely monetary aggregates behavior, development, and will take it into account in our decisions, which is a difference, I would say, from the past.
Thank you. Any other questions? Yes?
I have two technical questions, one policy question. The first one is that if I look at your forecast for 2025, you have wage growth above 5%. At the same time, if you look at the 3 months PRIBOR forecast, it is above 3%. So does it mean that you have changed some steady state in your model? This is the first question. The second question is that in the decomposition of 3 months PRIBOR change, you mentioned this expert judgment that reflects the impact of the higher administrative prices of the corporate repricing that is pushing the 3 months PRIBOR higher, but is offset by two other factors. So what is the net change because of this administrative impact on the corporate pricing? And the policy question is that there is, as Jan mentioned, there is relatively positive outlook on the fiscal finance development, not only in 2025, but also already in 2024. But the central bank or bank board continues to highlight expansionary fiscal policy. So what is the difference in your view compared to the staff forecast, if I can ask in that way? Thank you.
I'll start with the first technical question. No, we haven't done any changes to the parameters of our steady state. We are just expecting gradual convergence of the both nominal wage growth, nominal price growth, and nominal interest rates to the steady state, which is for the 3M PRIBOR still characterized as 3%, and for the nominal wage growth as at 5%. And this second question regarding the expert judgments and their contribution and their composition within the interest rate forecast change, the composition will be answered by my colleague Karel Musil.
Yeah, so the summation of the expert judgments or the overall impact of the expert judgment is positive. So in the positive direction, there is this contribution of the judgments about the story that is related to the adjustment of the prices or impact of the energy prices for the companies, and also for the regulated prices for the consumers. In the opposite directions, there are the judgments that are related to the review of the labor market, so lower judgments for the wage growth, and indeed the contribution of the judgments that are related to the prices are bigger, so that the overall effect overweights to the positive territory.
Yes, this public finance forecast seems to maybe realistic, but maybe too optimistic, and we are just perceiving this as a risk. So that's all.
Thank you. Any other questions? Yes, Mr. Jáč.
Good morning, Radomír Jáč, Generali Investments. I will have question for Deputy Governor Zamrazilová, and it's related actually to the slide number 19, where the scenario of stronger January repricing was presented. Because, I mean, if I take it seriously, it means that we will learn the data about repricing only in 3 months from now, somewhere in the second week of February. And in the meantime, we still have the pre-Christmas meeting on the 21st of December. And I just want to ask you about your feeling, because there is clear recommendation, or let me say outcome of the forecast to start cutting rates now in the current calendar quarter. The board identified some pro-inflationary risks to delay the start of rate cuts. So from your point of view, what would have to happen for you to have conviction that already in December it would be correct, let me say, safe time to start the cutting cycle?
Well, we will also watch this very closely. And for instance, I was quite shocked by the media reaction after the announcement of the increase of the part of administrative energy price, the administrative part of the energy prices by 70%. I hope I may admit that we were expecting almost that our interval was 70 to 80. So for us, it wasn't a surprise. And so do I think that this should not have been a surprise for the media and for the entrepreneurs. However, this happened, and the entrepreneurs were trying immediately to pronounce that, yes, we will have to reprice, etc., all the pressure groups coming up and speaking very loudly. So this was this 3 days old story led us to more cautious attitude. So we will watch this, because this is also about the communication of the government. The government, Mr. Finance Minister was presented yesterday at our bank board meeting, and we were discussing quite in a detail those prices. And he said that the entrepreneurs will pay no more than this year, that the prices will stay stable for them, but they want to get back some benefit or some pardon? Some favor, so they are a little bit sort of blackmailing or something like this, or because they look to Germany and some other countries and say that the energy prices for the entrepreneurs are cheaper there. And yes, if they decide to translate into January repricing, I think it will be announced even before in some. If we discuss with the entrepreneurs, and we will read and listen to them, so we hope we get some more detailed knowledge until the end of September. What are they planning to do with their prices? Because there is no core reason for that, as the prices for them stay stable. Moreover, as for the information available in 7 weeks horizon, 6 or 7 weeks horizon, we will know the October inflation. We will see whether our estimate of the administered prices was correct. We will see what the core inflation will do. We will know the data about wages in the third quarter. This is also interesting. We will also see the structure of the GDP decline in the third quarter. So we will have some new source of data, and we will try to communicate with some stakeholders to get some information, at least qualitative one, about their behavior. For instance, also I'm quite curious about your thinking, because I registered in the October IOFT that while you were decreasing your year-to-year expectations since January to September. At the October IOFT, I have registered that 7 out of 18 of you have increased your yearly forecast. Yeah, it's visible. On average, it's just 0.1 percentage point, but looking into the detailed structure, which is of course anonymous, but still I'm looking very closely to that. That 7 out of you have increased your inflation expectations. So I hope it was also only about the administered prices.
So, any other questions? Mr. Sobíšek.
Pavel Sobíšek, Unicredit Bank, good morning. I have just a technical question related to the forecast of fixed income formation next year. As I can see, you expect slow but steady growth in private fixed income formation for each quarter. So my question is whether there is some deeper idea behind that. If you can elaborate what kind of investment should drive the overall amount upwards.
You are possibly referring to fixed capital formation.
Fixed capital formation in its private part.
Yeah, the story behind the ongoing investment activity in business sector is still the same. Firms facing the tightened or almost fully exhausted labor market are making their best to increase productivity or labor efficiency by capital deepening. So they invest into automation, digitalization, robotization, and to energy savings and to energy more efficient ways of producing, and this effort is an ongoing one, long-term one, and despite domestic tightened monetary conditions, they will continue in doing this.
Can I add one question? Are you changing an estimate of the potential growth of the Czech economy? I'm asking because if fixed capital formation grows so slowly as seen here, and part of that will be just to make a change in energy sources, it would mean that probably investments into productivity will go lower than previously.
It might be the case. We have been for quite a long time discussing whether the current growth model of the Czech Republic has been exhausted or not, or whether it will be exhausted in the years to come. And we are permanently discussing whether the steady state assumptions of 3% potential output growth is still valid or not. So far, we haven't done any change for that, but when besides this core model assumption, we have also satellite model for estimating potential output growth and the output gap based on the small structural model and based on the standard Cobb-Douglas production function, and based on these satellite models, the potential growth rate is below 2, is maybe 1.5, 2%. And if this proves to be permanent, we will consider changes to the steady-state parameterization of the core model. But this is, it needs some work to be done further.
Are there any other questions? Yes, Mr. Paul.
Martin Paul, General Investments. I have a question to Ms. Zamrazilová. Two board members supported a rate cut. Could you shed light? What was, let's say, the main difference between these members and the majority of the board in the interest rates recommendation, or what factors were driven, or these members saw as more important than the majority?
Well, I would say this was very balanced debate, and the difference between those who were for the cuts and those who were for the stability was just a small difference in the balance of risks, and I would say that all of us were very close to 50-50. Yeah, so so this was really very, very interesting discussion. We were we didn't have any strong view differences, but this was just about the perceiving and the weighting of the risks themselves. So it was not, for instance, for the individual person to be 10% decided for that and 90%. It was about 40-60 or close to 50-50, I would say. So there were no special differences. Just maybe that some of us are more for the accommodative stance of monetary policy. Some of us are more conservative, and that's very similar to what I have said a minute ago. Thank you.
We have time for one last question, if there is any. Okay.
Hello, thank you for your presentation. Maidwan from Bank of America. I would like to refer back to your interview yesterday when you mentioned about the exchange rate delivering the easing impact. Can you elaborate more on the board's thinking about the exchange rate? Because sometimes we know that this is not always the way that you do this rule. You think about this rule of thumb as, one cut is about, 1% of depreciation. So how do you think about that personally so that we can see the exchange rate impact on your thinking going forward? Thank you.
Well, the difference with the past is that we are not now actively using exchange rate and don't consider the exchange rate to be a tool for us in the near future. Now we are just watching the interest rate, and we can say that this almost 1 crown depreciation is equal to almost 3 cuts, and this also gives some more time to wait with the first easing step. So that's all, and I would say that the exchange rate forecast that you have seen now is quite conservative and expects, if I remember well, stability of the exchange rate in the next quarters, in the coming quarters, maybe with a slight appreciation, but also this will be, of course, we all know that the exchange rate is the macroeconomic nominal variable that's most difficult to be estimated. So, if it's enough for you.
So thank you everyone for your questions. Thanks to our speakers. Thank you for your participation, and we look forward to hearing from you or seeing you next year. Goodbye.